Restaurant Brands International, ticker QSR, is currently trading at $73.26, and over the past 6 months, the stock is up by nearly 8.2%, and over the past year, the stock is up by a staggering 45%, which is an insane amount of growth for nearly any company over such a short period of time. And therefore today we will have a look at QSR in a bit more depth and evaluate whether it is a good idea to buy the company at its current trading price and whether that would yield you any real profit over the next few years. If we jump to tip ranks, we can see that the analysts currently have a 5.17% upside for the company, predicting a price of $77.05 by the end of 2023. The company also has 14 buy ratings, 7 hold ratings, and 1 sell rating. Now, this doesn't necessarily mean that the company would be a good purchase at its current trading price. And to figure this out, we'll jump over to my fully automatic stock valuation spreadsheets, where we'll have a look at the 9-pillar analysis and calculate the intrinsic value of QSR using the Grams formula revised, discounting cash flow model, multiples valuation model, and the dividend discount model. And all these models will lead to our ultimate valuation at the end of the video. Now if we jump back to the stock screener and plug in the ticker QSR and press enter, all the metrics will show up automatically. And right away we can see that the dividend yield of QSR is currently sitting at 3%, a very decent dividend yield indeed, giving us a dividend payout ratio of $2.20 per share per year, with a trailing payout ratio of 126%, a very high payout ratio indeed. I generally like the payout ratio to be below 50%, and when it is above 100%, it generally means that a company is essentially going to debt when paying for their dividends. On the balance sheet above, we can see that the total assets and total liabilities of QSR are sitting very close to each other, giving us a total equity value of only $2.5 billion, a fairly low equity value for a firm with a market cap of $33 billion. We can also see that institutional ownership is sitting at 86%, and the beta of QSR is sitting at 0.98, meaning that with QSR, the volatility will be similar to the overall market. Now we can jump to the 9-pillar analysis and look at QSR in a bit more depth. Right away we can see that the rating for QSR is sitting at 7 out of 9, a very decent rating. We can see that QSR had been increasing their revenue, free cash flow, and net income over the past 5 years. Now if we scroll down to the financials, we can see that indeed the net income has been increasing fairly well over the past 8 years or so, as well as the revenue, which increased by about $2.5 billion from the year 2015 to the year 2022, which is more than a 50% growth. Now with the free cash flow, it is a different story. As we can see, the free cash flow is very similar in 2017 to the free cash flow in 2022, revealing the fairly low free cash flow growth compared to the revenue and net income growth. Now if we scroll back up, we can see a very big red flag, which is the long-term liabilities over the 5-year free cash flow negative dividends sitting at the value of 9.22. Now what this essentially means is that QSR would need about 50 years, 50, to pay off all their long-term liabilities with their historical 5-year free cash flow, while of course paying out a healthy dividend. Now if we overlook this red flag, we can see that otherwise QSR is doing fairly well. Their price to free cash flow over the past 5 years is sitting at a fairly good value, as well the 5-year PE ratio, which is not sitting below 22.5, but it is slowly getting there. We can also see that the 5-year profit margin is sitting at 57.72%, a very good profit margin indeed. But now let's move to the first valuation model, which would be the Grams formula revised. To calculate the intrinsic value through the Grams formula revised, we take the earnings per share of QSR and multiply by the average yield on AA Corporation bonds. We then take that value and multiply by the sum of the base PE and the multiple of the 5-year growth estimate and the growth rate multiplier, which in this case would be 1. We then take that value and divide everything by the current yield on AA Corporation bonds, which is currently sitting at 3.72. And all that leads us to an intrinsic value of $55.08, which would be about a quarter lower than what the stock is currently trading at, indicating that the earnings per share of QSR is fairly low compared to the price the stock is currently trading at. But now let's move to the second valuation model, which would be the discounted cash flow model. Here we take the free cash flow over the past 10 years, which is fairly volatile as we can see, and calculate the average growth rate to be at 47.9%. Now, as I have just mentioned, the historical free cash flow of QSR is quite volatile, and therefore I project a growth rate of 8%, and using that growth rate, I calculate the future free cash flow of QSR, arriving to a terminal value of $40.8 billion. Now, to carry on with the valuation, we need to calculate the present value of that future free cash flow, and to do that, we need to calculate the discount rate. Now, to calculate the discount rate, we take the WACC of a company, QSR in this case, and compare it to the risk of investing into that company. Generally, the higher the discount rate, the lower the intrinsic value calculated. I generally don't like the discount rate to be lower than the WACC, and therefore, as I do believe that QSR will grow in the near future, I will plug in a discount rate of 8.23. And as you can see, the present value of that future free cash flow we just calculated is summed up. We add any cash and cash equivalents, subtract total debt, and get an equity value of $22.4 billion. We then divide that by the shares outstanding and arrive to an intrinsic value of $71.77, about $1.50 lower than what the stock is currently trading at. But now we can move to the next valuation model, which would be the multiples valuation model. Here I will be comparing QSR to similarly structured companies which operate in the same sector. These companies are YUM and DRI. I took these companies' current stock prices and divided by their current earnings per share to arrive to their price to EPS values, which I then averaged out and arrived to an average PE ratio of 26.77. We take the average PE and multiply by the earnings per share of QSR to arrive at an intrinsic value of $87.52, about $13 higher than what the stock is currently trading at, indicating that QSR might be slightly undervalued compared to companies which operate in the same sector. But now we can move to our final valuation model, which would be the dividend discount model. Here we take the dividend payout of QSR over the past 5 years and calculate the average growth rate to be at 4.11%. Now, due to QSR's very high trailing payout ratio and their very high long-term liabilities over the 5-year free cash flow, I project a growth rate of only 2.5% into the near future. We then plug in the yearly dividend frequency of 4, and using the projected growth rate, we arrive at the next year's dividend, which is $2.22. We then take that and divide by the WACC negative the projected growth rate to arrive at an intrinsic value of $38.40, which is much lower than the current trading price. Now, as this model is mainly based on the projected growth rate an investor projects, and as I cannot be 100% sure that QSR's dividend growth rate will be 2.5 over the next few years, I will jump over to our alternate model, which bases its intrinsic value on the stock price next year, which is predicted by many analysts all over the world. And therefore, through this model, we arrive at an intrinsic value of $70.14, which is about $3.2 lower than the current trading price. Now that we have completed all the valuation models, we can move to our ultimate valuation model, where we average out the Graham's formula revised, multiples valuation, discounted cash flow valuation, and the dividend discount model. I will press this tick here, and it will change to our alternative dividend discount model. And as you can see, the intrinsic value comes out to be $71.13, about $2 lower than the current trading price, or 3%. If we plug in a margin of safety of 10%, we would get an acceptable buy price at $64. Now, if we try to plug in a margin of safety of say 15%, that would give us an acceptable buy price at $60.46. Now, if we have a quick look at the trading chart for QSR, we can see that over the past year, the stock was certainly trading at our intrinsic value and even below it. With that, if you enjoyed the video, make sure to leave a like and subscribe if you want to see more valuations like this.